Why do certain businesses not only survive economic cycles, recessions, inflation spikes, and technological shifts, but actually emerge stronger? The answer isn't luck. It's dominance. And dominance, when paired with durability, tends to compound. This is the core idea behind the Monopoly ETF ticker, MPLY, from Strategy Shares, a strategy built around owning companies with enduring competitive advantages. Let's break down why dominant companies outperform over time, and why a focused strategy around them can make sense for long-term investors. Competitive moats, the foundation of long-term outperformance. If you study the world's most successful businesses, one pattern becomes obvious. They have moats. The term economic moat was popularized by Warren Buffett, who compared great businesses to medieval castles protected by wide, deep moats that keep competitors out. But what does that really mean in practice? A competitive moat is a durable advantage that allows a company to protect its market share and profitability over time. There are several types. Network effects. The product becomes more valuable as more people use it. Think of payment networks, marketplaces, or operating systems. Brand power. Consumers actively seek out the product and are willing to pay more for it. Cost advantages. Scale allows the company to produce goods or services cheaper than competitors. Switching costs. Customers face friction, expense, or risk if they leave. Intangible assets, patents, licenses, regulatory approvals. The key word is durable. Anyone can have a good year. But only companies with real structural advantages can protect high returns on capital across decades. This is where dominant companies separate themselves from average ones. They don't just compete, they control. Pricing power, the quiet superpower. One of the clearest signs of dominance is pricing power. Pricing power is the ability to raise prices without losing customers. In inflationary environments, this becomes critical. Companies without pricing power see margins compress. Costs rise, but they can't pass them through. Dominant companies can. Why? Because customers value what they offer enough to accept price increases. Think about essential software platforms, category-defining consumer brands, or critical infrastructure providers. When these companies adjust pricing, demand typically remains resilient. That pricing flexibility protects margins. Protected margins protect cash flow. Strong cash flow funds innovation, buybacks, acquisitions, and expansion. It becomes a self-reinforcing loop. Average businesses fight to survive cost pressures. Dominant businesses often use those same environments to widen the gap. Why leaders widen the gap over time? Here's something many investors underestimate. Success compounds operationally. When a company achieves dominance, several advantages begin to stack. First, scale reduces unit costs. Second, scale increases data advantages. Third, scale attracts better talent. Fourth, scale increases negotiating leverage with suppliers and partners. Fifth, financial strength lowers capital costs. Each advantage feeds the next. This creates what you could call the dominance flywheel. Smaller competitors struggle to keep up because they lack the resources to match R&D budgets, marketing scale, distribution reach, or platform investment. Meanwhile, the leader reinvests excess profits into strengthening its moat. This is why market share often concentrates in industries over time rather than dispersing. Leaders don't just defend their position, they expand it. The compounding effect investors care about. At the portfolio level, dominance matters because of compounding. Companies that earn high returns on invested capital and can reinvest at those high rates tend to compound value faster than the broader market. Over a short period, anything can outperform. Over long periods, sustained high returns tend to reflect a structural advantage. Dominant companies often exhibit consistent profitability, strong balance sheets, durable free cash flow. high reinvestment capacity. Resilience during downturns. That combination creates smoother long-term trajectories, not immune to volatility, but structurally advantaged. For long-term investors, that distinction matters. The problem with traditional indexing. Broad market index funds have obvious benefits: diversification, low cost, and simplicity. But they also own everything: the exceptional, the average, the structurally challenged, the capital destroyers. Indexes are weighted by size, not by the quality of competitive advantage. As a result, they may hold companies whose leadership positions are eroding alongside those strengthening theirs. A dominance-focused strategy asks a different question. What if we intentionally concentrate on companies with structural advantages? Not momentum, not hype, not narratives, but durable competitive strength. That's where MPLY comes in. What makes MPLY different? The Monopoly ETF is built around a simple but powerful premise: own dominant companies with durable moats. Rather than broadly replicating the entire market, the strategy seeks exposure to businesses that demonstrate strong competitive positioning within their industries. The idea is not to chase short-term trends. It's to identify companies that control meaningful market share, exhibit pricing power, show consistent profitability, operate in structurally advantaged positions. This approach reflects a long-term compounding mindset, not constant trading, not tactical timing, but disciplined ownership of companies is designed to endure. Why this matters in today's market. Markets today are shaped by rapid technological change, globalization, and digital scale. In many industries, the winner-take-most dynamic has become more pronounced. Digital platforms benefit from network effects. Software ecosystems create high switching costs. Data advantages reinforce leadership. In this environment, the gap between leaders and challengers can widen faster than in prior decades. Investors who recognize this structural shift may want exposure aligned with it. A dominance-focused ETF like MPLY reflects that reality. It acknowledges that scale and competitive strength are not accidents. They are strategic assets. Discipline over hype. What I appreciate about the concept behind MPLY is that it isn't built on speculative narratives. It's built on observable business characteristics: dominance, moats, cash flow, market share. That framework feels grounded. It avoids chasing temporary excitement and instead emphasizes structural advantage. No investment strategy eliminates risk. Dominant companies can face disruption, regulation, or strategic missteps. But historically, businesses with strong moats tend to have more tools available to navigate challenges than those operating without protection. That optionality matters. The psychology of owning leaders. There's also a behavioral component. Investing in dominant companies can make it easier to stay invested during volatility. When you understand why a company has pricing power, why switching costs protect it, and why its balance sheet provides flexibility, short-term fluctuations feel less existential. That confidence supports long-term discipline. And discipline is often the difference between capturing, compounding, and interrupting it. An ETF like MPLY packages that philosophy into a rules-based structure. It's not about picking a single company and hoping it remains dominant. It's about systematic exposure to a group of companies exhibiting those characteristics. A strategy built for long-term thinkers. To be clear, this isn't about finding monopolies in the literal regulatory sense. It's about identifying companies that operate with monopolistic characteristics, dominant share, high barriers to entry, structural advantage. The name reflects the philosophy. In my view, MPLY represents an intentional alternative to broad passive exposure. It says, instead of owning the whole market, own the leaders. Instead of weighing by size alone, focus on strength. Instead of assuming all market participants are equal, recognize that some businesses are structurally superior. That's not a guarantee of outperformance, but it is a clear thesis. And clarity in investment philosophy matters. Final thoughts. Over time, dominant companies tend to widen their advantages through scale, pricing power, and reinvestment capacity. Competitive moats protect profitability. Pricing power protects margins. Scale protects cost structure. And strong cash flow fuels the next phase of expansion. That cycle can compound for years. The Monopoly ETF is built around capturing that dynamic. It's a strategy that aligns with how many of the world's most successful businesses actually operate. For investors who believe that durable competitive advantage drives long-term returns, MPLY offers a structured way to express that view. Not hype, not promises, just a focused thesis. Dominance compounds, and owning it systematically can be a powerful way to think about long-term investing. If you found this breakdown helpful, subscribe for more deep dives into serious investment strategies, not hype, not speculation, just disciplined thinking. Drop a comment below. Do you prefer broad index exposure or focusing on dominant companies with real moats? Curious how others think about compounding. And if you want to research the Monopoly ETF ticker, MPLY, further, take a look at how it defines and screens for dominance. Always read the prospectus. Do your own diligence. But understanding the strategy is a great place to start.